When natural disasters strike, the financial impact can be staggering. From hurricanes and wildfires to earthquakes and floods, catastrophic events can result in billions of dollars in insured losses. So how do insurance companies manage these massive payouts without going bankrupt? That's where reinsurance comes in. Reinsurance is essentially insurance for insurance companies. It's a way for insurers to transfer a portion of their risk to another company, called a reinsurer, in exchange for a premium. By doing this, insurance companies can protect themselves from devastating losses caused by large-scale disasters, while ensuring they have enough capital to pay policy holders. Property insurance, in particular, relies heavily on reinsurance to protect against catastrophic losses. Natural disasters tend to cause widespread damage that affects multiple properties at once, creating large and unpredictable financial risks for insurers. Without reinsurance, a single catastrophic event could wipe out an insurer's reserves, putting their entire business and their policyholders at risk. Reinsurance can take different forms depending on how the coverage is structured. The most common types include treaty reinsurance and facultative reinsurance. Treaty reinsurance covers an entire portfolio of policies, meaning the reinsurer agrees to take on a set percentage of all claims within a given category. Facultative reinsurance, on the other hand, is purchased on a case-by-case basis, typically for unique or high-value risks that don't fit within a standard treaty. Another important reinsurance tool used for catastrophe events is excessive loss reinsurance. Under this structure, the insurer retains responsibility for losses up to a certain amount, but any claims beyond that threshold are covered by the reinsurer. This helps insurers limit their exposure to extreme losses while ensuring they still take on some level of risk. The reinsurance market also offers alternative risk transfer mechanisms, such as catastrophe bonds. These bonds allow investors to step in and provide capital in exchange for returns, with payouts triggered when specific disaster conditions are met. Catastrophe bonds have become an important part of the industry, giving insurers and reinsurers additional financial flexibility to handle extreme events. As catastrophic events increase in frequency and severity, the role of reinsurance is evolving. Climate change is driving more intense hurricanes, wildfires, and flooding, which means insurers and reinsurers are facing growing financial risks. With more losses to account for, reinsurers are adjusting their models to better price catastrophe risks. To improve their pricing and risk evaluation, reinsurers are leveraging advanced catastrophe modeling, artificial intelligence, and big data. They analyze historical loss data, climate trends, and real-time satellite imagery to refine their understanding of disaster risks. The growing risk of catastrophe losses has also led to rising reinsurance costs, which ultimately trickles down to insurers and policyholders. Higher reinsurance premiums mean insurance companies have to charge higher rates to maintain profitability. This trend has led to increased interest in alternative risk-sharing methods such as parametric insurance, which pays out based on measurable disaster triggers rather than traditional claims assessments. Looking ahead, the reinsurance market will likely continue adapting to a world where natural disasters are becoming more frequent and severe. Expect to see further innovation in risk-sharing solutions, new investment strategies in catastrophe-linked securities, and increased collaboration between insurers, reinsurers, and governments to find sustainable ways to manage catastrophic risks. Reinsurance plays a vital role in stabilizing the property insurance market, ensuring that insurers can withstand major disaster events while still providing coverage to policyholders. Without it, the financial system that supports disaster recovery would be far less resilient, making it harder for businesses and individuals to rebuild after major losses. As risks continue to evolve, reinsurance will remain a key pillar in keeping the insurance industry strong and capable of responding to future catastrophes. If you found this video helpful, subscribe and stay tuned for more insurance insights. Until next time, insurance gurus.